The main topic that we're going to be trying to figure out throughout this is, should you sell? And this is obviously based off of just the research that I've done. And, you're always going to want to do your own research. We're not financial advisors. This is just our personal opinion. But some of the things that we're going to be covering to support, the statement that, the statements that I'm going to make at the end are, what type of market are we in and what does that mean for the sellers? Then we're going to go over the nominal versus inflation adjusted home price data, what drives our national and local real estate markets, what's stabilizing our local and national markets in the short term versus what's destabilizing them in the long term, and the risk versus reward of selling now or waiting. How much bang for your buck are you going to get in the 1 to 2 month period, 3 to 4 month, or if you decide to wait a year or two or beyond. So just to start off with, this is a graph here that's showing the U.S. national home prices, which is the blue line, versus the San Francisco home prices, which would be the red line. Now, to clearly, show you what type of market we're in, which is cyclical, you're going to see that where I have the green arrows and the red arrows, we have a lot higher peaks and we have a lot lower lows, higher highs and lower lows than the national average. Now, every single market, whether it's cyclical, linear, or hybrid, is going to have some element of being cyclical. Everybody goes on the same ride when we have recessions and stuff like that. But the difference is you're going to see dramatically higher highs and dramatically lower lows in those specifically cyclical markets, and kind of to medium effect in the hybrid markets. Then the linear markets, which are typically in the Midwest, you're going to see more of a stable kind of upward growth over time with very minor cyclical elements. The markets that tend to be cyclical like us are on the far east and west coast, places like Miami, New York, Los Angeles, and then obviously the Bay Area, Silicon Valley. So, and then the hybrid ones would be places more like Tennessee or Orlando that are kind of in between. So what makes the Bay Area a cyclical market? Our home values, they're more closely tied to the national and international markets. We're obviously selling a lot of services and products that go, across the US and across the world. So when the economy is good and a lot of people are purchasing nationally and internationally, we're doing really good. But at the same time, when the local or global economy is doing bad, we're going to see the effects of that a lot more heavily. So that's one of the biggest things that makes us such a cyclical market. A lot of our home values and stuff like that are based on income, stocks, and subsequently the services and products that we're selling, that drive those values. So, in contrast, places in the Midwest and stuff like that are a lot of times going to be purchased by people that have their savings, right? They have a lot of blue collar jobs and they've just saved up a certain amount of money and they're able to go purchase a home. And that's partially from the types of jobs they have. And then that's also because of the prices of the homes in the different areas in comparison to places like New York and California, where a lot of the times you need that stock value that the companies are giving you in order to buy a home when you have to put, 100 or 200 grand down. So why does this matter? Knowing what type of market you're in, it's part of determining whether or not your home is overvalued or undervalued in comparison to the history. So, obviously, if your home is overvalued, assuming that there's no personal factors, whether you have to move now because you lost your job or there's, personal issues, whatever it is, that's going to equate to a good time to sell if your home is overvalued in comparison to the prices in the past 50 years, adjusted for inflation. So we can only tell you if it's a good time to sell relative to the past market. Nobody is going to be able to tell you or should tell you whether it's going to be the absolute best time to sell. Nobody's going to be able to tell you the peak, and nobody's going to be able to tell you the very bottom. The only thing we can tell you is, hey, over the past 50 years, these are the peaks and these are the lowest of the lows. It's a lot more likely that the prices are going to revert before the highest peak, and it's a lot more likely that the prices are going to come back up before the lowest low. And that's just based on the data. So How else can we determine if it's overvalued or undervalued currently? Well, we can look at the nominal versus inflation adjusted charts. And what that is it's the nominal chart would be the chart that a lot of real estate agents will show you, where it's like, hey, if you buy a home, you know, it doesn't really matter when, you shouldn't try to time the market because the prices are always going to go up. And then the inflation adjusted chart is taking that data and adjusting it for inflation and showing that you actually can, you know, to an extent, time the market a little bit. You're, like I said, you're not going to be able to find the highest high or the lowest low, but you are going to be able to determine some sort of risk factor based on the past when you're looking at the true graph. So the true data is kind of shown here. The top one with the black line going all the way up, that would be the nominal. That's not adjusted for inflation. And then this line here at the bottom that's red and has the purple line going through it, the red line is when it's adjusted for inflation. So if you take a look at that purple line running through it, which is to represent, it's not exactly where it's supposed to be because I manually put that, but you know, whether it's up or down a little bit, the point of this graph is that the prices, when adjusted for inflation, are always going to revert back to the mean. You know, yes, when you look at the nominal number, the prices are going to be going up over time, 500, 600, 700,000. But when you adjust it for your true buying power, you know, can you sell that home? And then how many other homes can you go, you know, and purchase? How many other assets can you go and purchase? When you're looking at your true buying power, there are times where it's better to buy and there are times when it's better to sell. And you know, within a reasonable doubt, can figure out, you know, kind of where we are when you're looking at this. So the inflation adjusted prices are showing us how close we are to the last peak in home values. If you look all the way to the right to that fourth purple arrow that I have, you'll see that from the last housing boom, where I have that green dot is about where we're at right now, because this data only went up to 2010 and we're in 2020 now. I couldn't find a good chart that showed the same stuff. But we're right about where that green dot is, which means when adjusted for inflation, we're pretty much at the highest high that we've ever been, if not a little bit below the last housing boom. So what that means is our homes are far overvalued currently. And based on the past 50 years, the prices have always reverted back to that average or that mean. So is it likely that we're going to go up another 50% and break the highest high we've ever broken in 50 years? Or is it likely that we're going to go back down to the average? Now, to answer that question, you have to consider, you know, what's driving our prices? What would drive that price up another 10, 20, 30%? Are we going to have some massive population growth and influx into the area? Are we going to have some huge income increase? What is going to give people the ability to change the supply and demand so drastically that it's going to launch us up? My answer to that is it's a lot more likely that, you know, now is a good time to sell and the prices are probably going to start working their way back down towards that mean. And that's, again, based on the data from the past 50 years. So to illustrate my point, when people say that the prices are always going up, even on a national level, you know, you have to look at the data. You have to look at the data from specific areas because real estate is hyper local. So even from 2006, if the chart had showed you that all the prices were going up, that would be averaged across the nation. So if you lived in Florida and you were looking at a chart that told you the prices were always going up and you purchased from 2006, your home value would have actually decreased when adjusted for inflation. But if you were in California, it would have increased. So that's why you have to look at that specific area. So if you were in San Francisco and you purchased your home in 2006, when adjusted for inflation, your home would be valued over 14%. So your home is currently overvalued basically 14% in San Francisco. And then in San Jose, Sunnyvale, Santa Clara, you would have seen a 46% increase. And that's above that average, that's above that mean. So that means that in that area, very specifically, in comparison to 2006 at least, the home prices are way, way overvalued. So the question for all of this is whether you want to risk, locking in your numbers now while you still can, or risk having it, potentially drop, or hope that it goes up a little bit further? And if it does go up further, how much is it going to go up? And those are some of the questions that you have to ask yourself. So what are the biggest factors that typically determine our property values? Across the US, it's going to be population growth, income, job growth, inventory, and lending difficulty. But the biggest things for the Bay Area, I believe, are income and stock values. And the reason I believe that is because if you take a look at our property values, this chart, it doesn't show the national average, but if you saw the national average here, you'd see that we are far outpacing it by quite a bit. And there has to be a reason. So is it that people are flocking here and there's an increased demand so big that our prices compared to the national average are just skyrocketing above them? Or is it that we're making more money? What is it that's causing that? So if you take a look at the data, in comparison to the rest of the US and a lot of places in California, we actually have a lower working population. So the massive population growth, it's always going to be a part of it. The population growth is always going to be a part of it. But in comparison to other places, we have a lower working population. So why are we outpacing them? There has to be another answer, right? So if you take a look at the next chart, I believe this is the answer to it. It's the fact that our incomes are, they're growing at such an exponential rate and people are making so much more money. And this is mostly due to a lot of these IPOs and companies that are coming out and having billions and billions of dollars of external cash coming in from other countries and across the US nationally. And that is providing these companies the ability to pay their employees $200,000-300 grand and offer them 100, 200, 300 grand in stock bonuses that are going to be locked up for a few years. So when a percentage of a percentage, because obviously not everybody's going to take that money and go purchase a home, but when a percentage of a percentage goes and buys a home, let's say out of a group of 10,000, if 1,000 in the next 4 years, once it's done being locked up, goes and purchases a home, that's a lot of home buyers, right? So, and they're most likely going to stay if they purchased a home here for that expensive, they're most likely going to stay for a while. So that helps to drive the inventory down. And then on top of that, the US in general has a 1 million home shortage of entry-level homes. And then on top of that, we also have an aversion to new housing developments. So the Bay Area, Silicon Valley does not like new housing developments. So we do not have enough entry-level homes. And our supply chain with construction companies and international resources are also strained right now. So our inventory for right now and into the future a little bit is going to be, affected. And it's been affected pretty heavily in the past because of the things that I was just mentioning. So that's been driving our prices up. And I believe some of those things are going to be what causes our prices to stabilize in the short term, at least. And, on top of that, we've also had another 180,000, if not more, listings pulled off of the MLS, which means that, again, we have a inventory issue and people are making a lot of money. So that causes these prices to go up. Now, just to kind of simplify it, when you look at our working population relative to the US and California, it's lower. Now, the low inventory because of lack of building and the Bay Area aversion to the new housing developments and then, the high paying jobs and the stock bonuses means that we have some of the highest property values because we have the same people working, but they're paying more for the same homes because there aren't that many more homes. Plus we have a little bit of an influx of population. So the problem is because there are a lot of things stabilizing the market, but right now with what's going on, there's also a lot of things destabilizing it. One of the biggest problems is because our prices are driven by income and stocks, you want to look at the data for income and stocks. And a lot of our mega IPOs, they are very negative when it comes to after going public. They're negative 30% for Uber, negative 30% for Lyft. Lyft is losing like 600 million a year. Smile Direct Club is minus 62%. And then the last one is minus 32%. Almost half of our mega IPOs are negative. So, the stocks that these people hold are worth a lot less. And then add on top, compound the fact that the situation, that's going on right now has also driven prices lower. A lot of these buyers that we have in the Bay Area that are purchasing homes from stock don't have as much stock value now. So, you also have to add in the fact that a lot of people have lost their jobs and filed for unemployment in the last few weeks, and that would be 22 million people. So the conclusion is that, a lot of the home buyers that are purchasing with stock may hold off since we're on the bearish end of the market, and they want to wait till their value in stock comes back up to be able to go buy their dream home. And they may have a perception that they're going to be able to get a deal down the line. And then our home buyers that purchase from savings may be laid off or have a fear of being laid off. So they won't be using their savings to make that home purchase in the coming months. And that's going to be a bigger deal in the Midwest, but it is going to affect us over here too. And then some of the things that are stabilizing the market, because this is all a balancing act, right? So the next things I'm going to be going over is what's stabilizing it in the short term, and then why do I think in the long term that it's being destabilized? How is this balancing act going to play out? So currently, we have super low inventory across the US, like I mentioned earlier, 180,000 listings pulled off, not enough entry-level homes. And, there's a decreased trend of construction towards starter and mid-sized homes because the developers are able to get a higher profit margin selling those luxury homes, making it for $1 million, selling it for $5 million. They're able to get such a bigger profit that they don't want to build these starter and mid-sized homes. Then on top of that, aside from the supply chain issues right now, construction is going to get more expensive for the foreseeable future because of what's going on as well. So you have, all of these things that are going to artificially and naturally keep our inventory very low. Now, the big question is whether or not, depending on how long this situation goes on, whether we have a foreclosure crisis or not, because everybody lost their job. So if it goes on for, 5 years, obviously nobody's going to be able, and we're in lockdown all the time, obviously nobody's going to be able to work, and then they're going to have to sell their homes, and that will bottom out the inventory, and all of a sudden we'll have a massive supply of inventory. But if this is over in the next month or two, then the damage is going to be a lot less. The damage is still going to be done, but it's going to be a lot less. So that's the only real question. Now, another factor stabilizing it in the short term is a lot of these homeowners, especially in the Bay Area, have huge home equity from these stricter lending practices. The people that are owning the homes since 2005, 2006, and beyond, they're people that are, they're more, what would you call it? I don't want to say not better homeowners, but they're more likely to keep their home and making the payments and stuff like that because the lending practices were more strict, which means that a lot of these people, they didn't have to sell their home or anything like that. So they have massive equity that they've been able to create over the past 15, 20 years. So some of the homes that are around here went from being worth, 300,000 to $1 million or whatever, when you're not adjusting for inflation. So this huge home equity is going to be a little bit of a buffer because people in 2005, 2006, they just purchased those homes and then all of the prices crashed. So they had no equity built up to take out, and they had no, they had no buffer. But now if you have all this equity, you're able to take a little bit of that cash out. And if you lose your job or you have your income cut in half because the wife has to stay home with the kids or dad has to stay home with the kids, then you're able to take some of that cash and use that as a buffer. Or, if you have an expensive enough home around here, sell it and go move someplace cheaper. So that's going to be a little bit of a buffer that stabilizes our market in the short term. And then we also have some of the lowest mortgage rates in over 50 years. That one's kind of self-explanatory. Obviously, the lower the mortgage rates, the more buyers we're going to have in the market. And the government is artificially trying to lower this by lowering the Federal Reserve. And then the banks subsequently lowered the mortgage rates for a little bit to try and, buffer the damage from this because they were hoping it was only going to last a few weeks. And then what happened is, now the mortgage rates are starting to come back up. So that's the issue. They can only artificially hold these mortgage rates down for so long, but they're going to start coming up. So, but while they were able to lower it, that creates that little bit of a buffer, but they can only do it for so long. So one of the last things that's stabilizing the market is foreign investors are parking a lot of their money in over here. A lot of these sites have seen a 400% increase in website visits in the past few weeks. Like the Securities from China International Corporation, forecasted 2019 to be a year of recession. and for the Chinese market, and a lot of their real estate home prices were, they're going down. And so they wanted to park a lot of their money over here. So a lot of people from China purchased, 40,000 plus units and $30 billion over here in the US. And the Chinese buyers equate for, I think it was like 24% of our foreign purchasers. Those websites were also seeing a lot of traffic from places like Germany and other locations over in Europe and stuff like that. So the negative side of things, we have stuff that's stabilizing the market, and then we have stuff destabilizing it, I believe, after the few months is over, because the government can only provide so much support to try and keep small businesses afloat and to try and help everybody out. The government can only offer so much assistance. Mortgage rates, they're going up now. They're not going to be able to stay down. The lending practices are getting even stricter, so there's subsequently going to be less buyers. The big corporations only keep so much cash on hand because they like to keep their balance books as close to zero as possible. And so they're only able to pay for people to stay home for so long before they have to start laying people off. They don't have infinite money to be able to just have everybody keep working from home forever. And then that damage is going to obviously be based on, how much longer people have to stay home. So the banks are taking less risk. Unemployment will increase beyond the 22 million. Just in the first few weeks, we've had 22 million people file for unemployment, but it's obviously going to increase because this situation is most likely going to come in waves. It's very unlikely that we just have, as they say, flattening the curve. It's very unlikely that it goes up and then comes straight down and we never hear from it again. It's probably going to go on for at least a year or two. The only question is it going to be a big wave? Or is it going to be, a big wave and then go down to a little wave because everybody controls their behavior and doesn't go out and, doesn't go to the clubs and stuff like that after this opens up and get everybody sick. Then we're going to see pay cuts. The government is only offering the payment protection plan assistance for those 8 weeks for the businesses up to 100K. So if you're making over 100K, your employer may decide to cut your pay in order to have their full portion of the loan that they took from the government from the payment protection plan covered. And then we have businesses are going to be more conservative with hiring because, the economy was going good. We had a bunch of hiring going on, but right now they're going to want to be more conservative unless because of what's going on, their industry is booming. If they're making masks, then they may hire more people. But for the most part, most of the businesses are going to be more conservative with hiring. So we're going to have a lower employment rate, especially when the pay is tied to the government assistance programs, like I said. Then we're going to have less consumer cash on the, once these companies come out, they're going to have less consumers purchasing from them, especially, the e-com will increase, but for all the public services like Uber and Lyft and stuff like that, if people aren't driving around, those companies aren't going to be able to stay above water. We're going to have less investment. And then all of the, the schools are going to stay out. Even if the majority of things open, they're probably going to keep the schools down for quite a while. So the pay of a lot of the people that own their homes or are renting and have kids is going to be drastically cut because one parent has to stay home with the kids. And then on top of that, the home equity is only going, like I said earlier, it's only going to create a buffer for people that have it. If you don't have the equity, you're not going to have that buffer. And then the international markets we're tied to are going to continue hurting for a long time because the US on the grand scheme of things is pretty spread out. But in comparison to places like India and stuff like that we get a lot of our products and employees from and stuff like that, especially in the Silicon Valley, they're going to have a lot of problems for a while because they have such a dense population and a lot of these countries have a poorer population. So they're not able to stay home for a few weeks like we are. Their companies can't support that. They can't support that. They don't have the savings. And that is going to affect us because we are a global market now. So what does this all mean? I tried to simplify it as much as possible. I know this still looks a little bit complicated, but I'm going to try to break it down the best I can. In my personal opinion, and this isn't just because it's convenient for, us for real, because we are real estate agents or anything like that. This is my genuine opinion. I think selling now is the best because even though, we may be going down from like 34 offers in the past few months or past few years down to like 4 recently, those 4 offers are still going to be able to be competing against each other, and be able to conserve your price. If you're in Santa Clara and the prices are 45% above, they're at 1.3 right now in your area, you're probably going to be able to get your home sold for 5% above or 5% below, or for market value as it's determined in the area now, which is good. You're still way above that average, as I showed you earlier. So that means that now is a great time to cash out. It's been for quite a while a good time to cash out. And now that you start seeing these cues like, hey, the economy's kind of going down, this is happening, that's happening. Should I risk it and hold out, or should I just sell now? When you start asking yourself those questions, that's when it's the time to sell. Because when you don't have the answers, before we had the answers, okay, the IPOs are making so much money. There's all these people coming to the Bay Area. There's a lot of foreign investment. We had the answers. When you don't know why you're keeping the home, you're just kind of like, okay, I hope the prices go up. There's no clear answer. Then, everybody else is thinking the same thing, and things are quickly going to be driven by emotion and natural and artificial factors. So the benefits of cashing out now is, if you're in San Francisco, you're going to see you're 13% overvalued. You've made your money, you've made your equity. Or in Santa Clara, you're 45% overvalued. You've made a ton of equity. You got a $700,000 home and you're selling it for 1.3 or 1.4 million. Like, you've made your money. Like, get out while it's good. So if you're selling in the short term, 2 to 3 months, it's medium risk and low reward, because what are the odds that in 50 years your prices now that are at the top of the top are going to go above the last housing boom? It's never broken that point when adjusted for inflation. So the odds of it going above it are very, very low. So let's say you have a 10% chance that it goes above, you make another 5% on your 45% you've already made. Okay, that's amazing, right? But the low reward side of things is, if things don't go right and this situation continues on for another month or longer, then you may lose that 5, 10, 20, 30% of equity that you've built up if your house is overvalued. And it might go below that line even further. And the more expensive the home, the harder it's going to be hit. The $1 million range is probably going to see anywhere from 5 to 15, 20% in the long term. And then the luxury homes, they may see huge price cuts. So if you're looking to sell in 6 months to 2 years, I just can't see really a single reason to wait it out, because we are, everybody thinks we're in a recession right now. We are very, very likely in a recession right now. When the prices go down, there are less jobs, there's less money in the economy. The recessions are not always directly tied to the real estate market, but everybody's going on the same ride. Like I said earlier, when prices go down and across the board and people can't purchase homes, there aren't as many jobs and all of that, the prices are going to go down. And there's nothing that I could see drastically increasing our demand in order to make prices go up in the next 6 months to 2 years. I could see in the short term, if this stops right now and all of a sudden they open up the market today, I could see a lot of buyers flooding the market before sellers can put their listings out. And then that will, in the short term, maybe give you an extra 10% max. But immediately after that, once they realize, okay, well, nobody else has jobs and all of these people were able to get their listings on the market, and there's nothing in the long term that's going to drastically increase demand, then we're slowly going to see, people start to sell, and then people are going to panic sell. And then the only question is, in the 6 months to 2 year period, what's the bottom going to be? Is this situation going to continue for 6 months and the bottom is going to be very low because we're going to have a lot of foreclosures, foreclosure crisis? Or is this going to be over in another month and it's going to be kind of medium? The question is, are we, in a recession or an extended recession? That's the only question. And I don't see anything positive that's going to all of a sudden, okay, make 1 million more buyers come onto the market. So what should you do? You should consider the upside to waiting it out. How much more are you going to make if you were to sell in this time period versus that time period? Then you're going to want to consider the downside to waiting. And then finally, you're going to want to consider your personal factors. You know, what's your job stability? Do you have a $200,000 job and you're not worried about losing it at all? Your company's doing great. Your industry is doing great in this situation. How much home equity do you have? Do you own 100% of your $1 million home? Okay, take out a little bit of cash right now for a buffer just in case you do lose your job. And, you know, and then if you're not comfortable selling now, it's okay to make that decision because you have that ability. And then taking a look at your time frame and, you know, and so on and so forth. So part of all of that, because it is such a big topic, is wanting to discuss your options. So if you guys need help, again, like Vlad said earlier, just, you know, reach out to us after this and we'll be able to set something up to help you guys out. So